I was blown away by the wealth building concepts that you taught.
My name's Kenny Dahill. We know each other from Toastmasters. I'm born and raised in Arizona. I love investing in real estate and other financial mediums.
People should not pay off their mortgage. It's kind of against the grain of what people like to hear. Let's talk about your mortgage hack that you talked about.
Over the 30 years, maybe they save 5 years and it adds so much of interest in there. Mortgage paid off faster. And the way you utilize this is a year you make one big payment. And every month from now on, you pay back against a HELOC.
Is it because the amortization time for HELOC is shorter? Kenny, I'm so happy you joined our session. I was blown away by the wealth building concepts that you taught a couple of weeks ago. And then I thought I have to bring Kenny here. Introduce yourself.
Absolutely. Well, it's my second time on this podcast. My name's Kenny Dahill. We know each other from Toastmasters. I'm born and raised in Arizona. I love investing in real estate and other financial mediums.
The concept that I want to talk about, I love the fact that you're born and raised here because you probably have seen most of what's happening around Arizona, the growth and the families that are moving in. The concept that I want to hone in on is the mortgage hack that we talked about.
Okay.
So it's of course groundbreaking. All of the families that I work with, they typically say, oh, I want to pay off my mortgage, right? My personal experience and opinion is people should not pay off their mortgage. It's kind of against the grain of what people like to hear. When families come to me, they say they want a 15-year mortgage. And I try to push them to a 30-year mortgage because I know that there will be other opportunities coming in.
Yeah.
And do that. But then this is slightly different. So let's talk about your mortgage hack that you talked about.
Okay. So I'm intrigued because you are a mortgage lender, right?
Yes.
So to hear your perspective on all of this, I'm intrigued. So let's see. So you do have options talking about paying off the mortgage, the pros and the cons out there. A lot of people will chip away at it, right? They'll just say, I make an extra $50 a month or an extra $500 a month. And they try to get over the 30 years, maybe they save 5 years and it adds so much of interest in there. There's something that I've copied from somebody else, I've heard. I haven't actually done it myself, but I understand the principles, and I just call it the mortgage meltdown. The reason we call it mortgage meltdown is, well, let's just get your mortgage paid off faster. And the way you utilize this is using a HELOC, which is your home equity line of credit. And typically a HELOC can go, I believe, up to 90% loan to value. So if your house is worth $500,000, you can take up 90% of that, minus whatever you owe in debt. And then you, at the beginning of the year, you make one big payment. For example, you could pay $1,000 a month, right, on top of your mortgage. That would mean you pay your mortgage $12,000 more per year. Instead of those $12,000, you're better off in January 1st paying one lump sum $12,000 payment. And what that happens is it lowers your principal for the rest of the year. And then you pay back your HELOC. You borrow $12,000 against your HELOC. And then every month from now on, you pay back against a HELOC. It really comes down to just how interest works on a mortgage versus a HELOC, and having that bigger payment up front, how that saves you interest on your mortgage.
Is it because the amortization time for HELOC is shorter? That when you, in the same example, right?
Yeah.
You pay $12,000 ahead of time on the main mortgage, and then the HELOC, you pay it down every month.
So it really comes down
to...
What's
the comparison? Is there a matrix comparison, like a race, which one is better?
So there's a difference of interest out there. Interest isn't just interest. There's different types of interest. So a mortgage is what we call amortized, meaning it's got a schedule, kind of like your car payments. You know I'm going to pay this car off in 5 years. With amortized, they typically put more interest up front and equity in the back. So to understand a quick high-level 30-second synopsis of amortized loans, on a 30-year mortgage, you pay mostly interest up front, principal in the back. It's not until about year 18 that you're actually 50-50. At year 15, now halfway through the mortgage, it's about 18 years in when you finally start to pay more principal than interest. Whereas a HELOC is simple compound interest. It works like a credit card. The longer that your debt is out there, it just means that you're going to be paying a daily interest on it. So it's easy to predict. You can get out of control, right, with credit card debt. But if you can use it correctly, you can actually pay it back faster. And it's easier to pay that down. And then it frees up more line of credit for you as well.
Oh my God. Right now my brain is exploding because this is this is a hack that no bank would like to hear,
So
right?
I believe it might be borderline illegal. So
Yes.
to use a HELOC against it would be.
In our podcast, we talk about different hacks on different things and we share our experiences, what it is. It's absolutely for the people who are receiving it. They have to understand the risks
Yeah.
and then they decide. But at least on theory, on paper, does it make sense? Like, of course, there is one lender. If you have a loan with Chase, if it's at 3%, you have it, and then you go to a credit union and get your HELOCs. Typically, HELOCs are done mostly by the credit unions. What I'm hearing is the way the calculation is made is different for mortgages and HELOCs, if I may summarize.
Yep.
So for the mortgage, it's amortized for the term, which is either 15-year or 30-year that you have. While for the HELOC, it's not amortized like that, but you have a compound interest there. So if the 12,000, instead of paying $1,000 extra for the mortgage, with the HELOC, you just take 12 grand and pay the mortgage at once. So your total interest cost over the next 12 months will be much lower when you do it this way, wherein you take money from the HELOC and pay it off. And obviously, as soon as you have money, you can just keep paying the HELOC as fast as you can if that's the goal for you.
Yeah. So the important thing to understand here is the amount you're paying your mortgage down by, that extra premium or extra principal that you earn every month has to be bigger than the interest payment. So if I put $12,000 down, does that save me for the rest of the year? Am I making all of a sudden an extra $50 of principal per month? But my interest rate, if it's more than $50, might not be the best situation. But if it's lower than 50, and you want to take the full year because you're going to pay more interest up front on a HELOC, just because you have a bigger balance. But as you pay that balance down, your interest is going to get smaller and smaller and smaller.
That's great. Actually, this hack works even better if you just enough equity wherein you can get the HELOC and your mortgage is new, in the sense that you haven't passed the 18-year mark for a 30 years.
Yeah.
Because I remember when we had the boom of the refinance, one of my mortgages that I had a 15-year and it had only like 5 years left on it, and my interest rate was almost 4.25. While the prevailing market rate was 2%, even then I had to make the calculation. On paper it makes sense. Oh, it's 4.5. Now you can get it down to 2.5, but it doesn't make sense because you already paid all the interest. Now you're only paying principal.
Yeah.
So you have to be smarter about it. Otherwise, if you just go on, carry on with the news and the media, oh, the interest rate is lower, boom, you refinance it and your term is again 15-year or 30-year, and people think they are saving money.
Yep.
But they are not.
No. So the sweet spot you have to understand as a lender, you want to keep people within the first 10 years of a mortgage. Why? Because I mentioned earlier that the first 10 years you're paying like 60% of your payment. So I have $1,000, 600 of that is going towards interest. Banks and mortgages, they want to keep you in that sweet spot where you're always paying more interest than principal. So that's why you got to look at like how many years is left over. Am I going to go back to like maybe now I'm 50-50 principal interest to start all over where I'm going back and paying 70% interest, 30% principal? You're not getting that true wealth building, the principal. You're not getting it as fast. You're paying the same amount of money, maybe a little bit less per month, but you're not getting that true wealth in the long run.
Exactly. And Kenny, you and me are big on wealth building concepts. Those are like unconventional or non-traditional or not spoken as much. So I'm very excited that you shared this mortgage hack. I'm going to try to put together a calculator. If you guys want to have the calculator, I have this calculator already, wherein if you have a mortgage, if you have to refinance, I can tell you if it makes sense to refinance or not. Because even though if you have lower mortgage, sometimes it makes sense to refi, sometimes it doesn't. So we have that calculator. I'm going to work with Kenny and try to come up with this calculator also, wherein we can figure out, hey, if you are getting a HELOC, how much it's going to save and exactly how quickly you can pay off the mortgage.